separates it? Like, why would somebody do seller financing versus the cash things? Like, I get this and I get that. And that's a good thing for me to realize because I'm so deeply involved in seller financing that sometimes I forget, like, oh yeah, this is freaking awesome. Like, this is way better than options that we get in cash deals.
So this episode is more about the rah-rah of how awesome the strategy is?
Yeah, it is. It's a rah-rah about how awesome seller financing is.
Why is there a fly? Anyway, sorry.
Because it's the world and flies exist?
I know, but we have never had flies in the studio while we're live.
So, okay.
Sorry.
All right, so
I broke you.
You did. So that's what I want to jump into is let's talk about, because I think the other side of that too is why this is a rah-rah for the awesomeness of the strategy is there's not really fantastic knowledge out there on the internet about seller financing and subject to. And I know that because I tried to get started learning this stuff off the internet and it just wasn't there. Now things are getting better and it's cool to see that like Propelio and CreativeCashFlow.com have a hand in that. A lot of the people that you're learning from were taught by me or were learning from Propelio or something like that. And so it's cool to see that that overall knowledge base is growing. But this is something that we want to do to really get out the nuts and bolts of what it is, why is it that seller financing wins over cash offers, okay? So let's start off by thinking about this. And I want you guys, I don't know how much delay we have on here, so I'm gonna try and get some cooperation. Are you guys ready to cooperate with me? Type me a yes if you're willing to cooperate with me here and we'll go from there. All right, so here's what I want you to tell me. In conventional knowledge, right, when we're buying with cash, conventional knowledge says that we need to buy at like 70 to 75% of the ARV, right?
Okay.
Which means that if the ARV, the after repair value, is gonna be $100,000, of the $100,000 ARV, and we want to buy at 75%, that means that we want our total basis, our acquisition, and our rehab to be under $75,000 in this example. So, all right, awesome. I got Jeff, I got Jeremy, I got Sohail ready to participate.
He's so mad at me right now because I'm trying to make sure. This is the first time we've ever tried to go YouTube Live and Facebook Live, and they're live.
Cool.
But you're mad at me because I'm not interacting. I'm here now.
I wasn't mad at you. I'm mad at you for interrupting me.
Shit.
Freaking.
My bad.
I'm joking. I'm not. Okay, so we got some people willing to get. So why is it that conventional knowledge tells us we need that discount? What do we need that? Why do we need that discount?
The real answer?
Yeah, I want it. Let's look at the real
we're
answer,
using
and I
other
want you
people's-
guys to pop in there too.
Well,
No, this is a full thing. Like,
okay.
yeah.
Well, I was gonna say because the reason you have to have the built-in discount if you're a cash buyer is your typical cash is not your cash. You're having to pay for that cash.
Okay.
So you have to build in a spread that you can cover your fees.
Okay.
You know, so that's one reason. Also, if you're a flipper, you need to build in your fees that you're going to pay on the backside for the realtors. Because maybe on the front side, you're not having to hassle with realtors, but typically on the backside, you are, because you're in the business of flipping a house and getting it occupied or whatever.
Right.
You're not in the business to sell houses to the market.
Right.
That's why you employ a realtor. So your financing fees, your realtor fees, and then obviously if you're buying cash, your pitch is always, I pay closing costs.
Right.
Well, you got to build those closing costs into the deal. So if you're buying at 75% minus repairs, typically 10 to 13% of your profit, I don't know why I keep doing this, is going to those fees.
Yeah.
So at a 75% minus repairs, you're really looking for a 10 to 12% profit margin
Of the ARV, right?
Of the deal.
That's not necessarily an ROI because 10%, whatever. But that's
I'm
of the ARV.
just talking
right.
about like $100,000 purchase,
Right.
$75,000,
You're gonna get $10,000 to $12,000
whatever,
in profits.
$20,000 rehab. You're buying it at 55. You put 20 into it. Now you're at 75. You sell it at 100. You're going to make 10 to 12,000 on the deal.
Right. And so, and also I want you guys to pop in here. Jeff Steele put money signs down there. Yes, money is one reason. If you guys have any input on why we have that discount, I want you to know that too, because yes, we've got to have that discount to absorb our costs. We've got to have that discount to absorb that and still have room to make money. But what was it that makes us arrive at that 70 to 75% number?
Arbitrary.
Like, why is that conventional?
Why is it conventional today?
Why is it conventional? I mean, it's been conventional. Like the 70-cent offer was forever, and now it's 75 or 80 or
like
82.
when we first started, it was 65%.
Yeah. Yeah.
You know, because I remember, you know, we used to office in the same building, and back then I was with Homevestors, and back then the train of thought was 65%, 65%, 65%.
We've seen
Fast
that go
forward a
up.
few years, then it's 70. Now 75% is on the low end. If you are buying from a wholesaler, you have to buy 80, 82%.
So that's a very good point. And why has that gone up?
Competition.
Competition, and the competition has risen because our market is like hotter, right? And so what it boils down to is that we have, in theory, a smaller risk today than we did 7-8 years ago, right?
Smaller risk?
When we buy that house, the risk that we're going to have to hold that house for way too long, the risk that we're taking that says that we're not going to be able to sell the property for what we hoped for is smaller than it was in 2010, 2011.
Explain that logic to me.
So that logic being, in 2011, our average, it's funny, I actually found a marketing piece that I sent out in 11, and it said, the average days on market is 7 months. I can buy your house tomorrow with, right? So our average DOM was 7 months.
In 11?
In 11. 6 or 7, something like that. At least here in the areas that I was looking for. Well, so that means that when we buy that house, there's a risk that it's going to just sit out there. And we're going to be paying money and having to absorb those holding costs and all that kind of thing. And nowadays, we're so hot that the risk is very small. I've got hedge fund buyers that are buying properties from me at 90 to 94% wholesale. I'm assigning them properties at 90 to 94%. So if you've got a property in Dallas or Houston, let me know. We can wholesale that together. But there's hedge funds out there the risk that I'm taking by taking a cash deal is very minimalized. Therefore, we're willing to push that LTV up a little bit because we're not risking as much.
And I will say this, just because we're on that topic of days on market, I'm not who's the guy, the sky is falling? Who's that guy?
Chicken Little.
I'm not Chicken Little, the sky is falling, but we have plateaued a bit on the speed and the hotness of the days on market. And days on market are, at least in the DFW market, are starting to increase again. But again, increasing relative to 0 days on market versus 7 months is a completely different story.
It's so funny to see people start to freak out about that.
Yeah,
I'm like,
yeah.
I'm sorry that your property took 3 weeks to sell. Like,
right. So I just want to put it out there because we're talking about it. So there is. Can your stuff sell for 0 days, 1 day on market?
Right.
Yeah, if it's priced right. But if you're pushing the market like it should be, because that's what the market calls for, it may take 20 days, 3 weeks, 4 weeks. But compared to 7 months, that's still nothing.
It's still nothing. And even when it goes, and that's actually going to be one of the points that helps us out here. But back to this specific part is that 70 to 75% conventional knowledge is built in because of risk. We have determined through the market that the risk that we're taking by putting that cash up is offset by the discount that we are getting on the property. That's what determines that number, is that we're saying for us to take the risk of putting $75,000 up on the market, we would need that house to be worth $100,000.
Can I pause 2 seconds?
Please.
Just because we got a comment from YouTube, and I'm excited. But I didn't bank on this, because in Facebook uses names. So Drunk on Soul P. What about bringing you deals for Phoenix? Because you were talking about your hedge funds.
Yeah, my hedge fund guys aren't in Phoenix that I know of right now, but you can message me. I've got like 3 or 4 hedge funds that I work with, and so I can shoot it to them and see if they have buyers, just because I haven't shot stuff over in Phoenix before. So still message me. I'm tagged on, or I think I should be tagged on. Am I tagged on the YouTube one too?
It's your name.
You can go to CreativeCashFlow, youtube.com/CreativeCashFlow and get to me that way, or you can go to Facebook.com and look up Grant Kemp or Creative Cashflow there and get to me that way.
And then also the AZ Flip guys, they're friends of ours. They're out there. So if you're not in connection with Chris or BP, I'll hook you up there. So anyway.
So we have a risk that's being tolerated by the discount we take in that cash purchase. Now, again, that is because we're putting out $75,000. Now, if we're talking about doing seller financing, our ideal seller finance scenario, and please understand that there's a million different ways that seller financing is going to work. Seller financing, by the way, is an umbrella term that encompasses subject to, wraparound mortgages, free and clear owner financing. There's all kinds of stuff that goes under seller financing. So when I say seller financing, I'm purely referring to the seller is holding the note for us when we buy the house, or when we sell the house. Today's episode is going to be purely on acquisition.
Okay.
Why are we acquiring with subject to or owner financing? Why is seller financing a great acquisition model?
So we're not talking about the owner financing out. We're only talking about the seller.
Exactly.
John Smith selling to Grant Kemp.
Correct.
And that model.
That model. This is why we would choose seller financing over cash models like wholesaling or fix and flipping or even renting, that kind of stuff. Now your exit is, when I say renting, that's an exit plan, but still just getting that in our mind. So again, we've got this risk tolerated. Now, in an ideal owner financed, seller financed, by the way, those are synonymous. Owner financing, seller financing are synonymous. In an owner financed scenario, ideally, we're not putting any money down. And I've bought probably upwards of 60 homes where I literally spent $0 of, I know my first 45 to 50 homes, I literally spent $0 out of my back pocket because I had $0. That's how I bought those houses.
Right.
But ideally, that's where we want to be. Now, you might have to catch up somebody's back payments or something along those lines, but your disposition side should pay that off for you.
But to be clear on that, because I think somebody new to the business may think your strategy is only never putting money up.
Right.
There are still deals out there where, yeah, it pays. Grant might not do this, but there are deals out there that it pays to give somebody $5,000, $10,000, $20,000 walk-in money and still do the seller finance model. So don't be closed-minded just because, yes, we're talking about the free houses per se. There's still opportunities that it may not be free, but it can still be a hell of a deal.
And
so
that's exactly
keep
what I meant when I'm saying, like, there's a million ways to do this. Today, for the sake of time, we're going to be referring to a lot of, like, not putting money down up front. But you're absolutely right. I do run into deals all the time where we're putting 10, 20 down up front. But I'm leveraging that through different methods that you will see in previous episodes of Grant Teach Me Something if you go back through the model.
Second liens and third liens.
Yeah, exactly.
I don't know why I'm singing that.
And Eileen has a question. Seller financing to flip a house, good idea or bad idea? Great idea. Again, what I'm talking about is acquisition, right? We're not talking about disposition. You can do anything you want once you buy your house with seller financing. We're talking about acquiring the property with seller financing. In this ideal scenario, we're not putting any money up for it. That's what we would like, right? Well, if the point of buying at 70 to 75% was to protect the fact that we have $75,000 out in cash, then why do we need that discount on a property that we are not putting cash in on? You see what I'm saying? Why would we need to buy at a discount if we're not putting actual capital on the line? Because we're not risking anything.
I think, again, it goes back to what we were talking about at the very beginning, or what you were talking about, and it's that mental, just everybody's brainwave is there. It's that arbitrary decision.
This is why I'm explaining that out, is it's like, let's talk about why that number exists so that we can understand why we can take advantage of why that number exists.
Yeah, because I know you've talked on 30 episodes here about the ability to pay at those higher rates. I know Daniel has talked all the time about paying above asking, above market, because it's all about the terms.
Yeah.
So, you know, everything in real estate is always negotiable. Some things are arbitrary. 65%, 75%, those are arbitrary. The 1% rule for rentals, that's arbitrary. It makes financial sense, but if you have $1 million and you want to buy $1 million home that only rents for $1,000 a month, guess what? You can do that.
Absolutely.
It ain't going to be financial sense, but
again, that's part of why we're discussing this particular section is, why is that arbitrary number there? Well, it's to protect our money.
right.
Okay? So it's one of those things where it's like, if you only know the rule, then you don't know how to break it. What we're explaining here is why that rule exists. Because if you know why that rule exists, then you know how to wisely break it. You know what areas can lead you into saying, oh, well, then I don't need this rule if this exists. Well, the rule exists to protect your cash. Well, if you're not putting cash there, then why do you need the rule?
So on that, so say, let's just take this, the fix and flip 75% minus repairs model. If you have cash and you're not using hard money, you're not using private capital, you don't have financing costs, guess what? You can buy at 80, 85%.
Well,
I wouldn't, but
yeah.
you could, because those costs that you would be spending, you don't have those costs anymore.
So part of...
But you're not leveraging other people's money when you do
Right,
that.
and you should be. When I say you're putting cash on the line, I don't care where that cash is coming from either. It could be out of your bank account, it could be through funding, it could be through anything, but there has physically been $75,000 that transferred from the title company. That money needs to be protected somehow. These percentages, and you're right, I mean, you can absorb that stuff, and that's why cash buyers are buying at 82%. It makes sense. You're paying the wholesaler for the work that you would have had to do to get there. It takes $5,000 or so to get a closing on a lot of marketing. You know, all those things make sense. But we're trying to teach principles here, right? So the discount exists to protect your cash. If you don't have cash out there, break the rule. You don't need that protection. Those discounts say that in your worst case scenario, you should at least break even. That's why that discount exists, that your worst case scenario should break you even. That's why that number has been arrived at. So in our worst case scenario, on an owner financed property that we have not put capital into, it doesn't matter what LTV we close at. It doesn't matter what basis percentage we're at, because the same thing holds true. In our worst case scenario, no cash has been lost.
Can I throw in a nugget?
Please.
So on that whole worst case scenario mindset, you should never be going into any deal, whether it's a fix and flip, whether it's a wholesale, whether it's a seller finance option, sub 2 option, without first analyzing, and I learned this from Daniel, every single deal he looks at a worst case scenario, a best case scenario, and a most likely scenario. So if you can't live with any of those scenarios, it's probably not a deal, and you might need to pass. But the reason I bring that up is because most people, they don't really think about the worst case, and then they don't really think about the best case, and then so it's just a matter of really try to go, okay, what if my rehab is higher and my sales price is lower? What if my rehab is lower and my sales price is higher? Really try to go through those. But anyway, the whole point of that is it's an obvious statement, but just really try to figure out or project worst case, best case, most likely. And if you can live with those, you should be golden.
Absolutely.
Sorry.
And I agree with that wholeheartedly. That's one of the things that I always tell people is if your worst case scenario is livable, then cool, do it. Okay, so we've hit 2 of our first 2 points of the 7. Point number one is that it takes low to no capital to get into these deals. In a scenario with owner financing, you heard me mention, I'm just kind of throwing this out and saying like, hey, my first 45, 50 houses, I literally spent $0. That's not hyperbole. That's not me just trying to sound good on camera. I literally spent $0 out of my back pocket because I literally had $0 to spend. So you can buy houses with low to no capital, and when I even say like the low capital, maybe $5,000, $10,000 will get you into these houses with seller financing. And in that way, we do have some rules of thumb that we've talked about in previous episodes of how to protect that cash, because this is unconventional. This is a different way. We're not just doing a straight 75% rule. We've got to look at some other rules to how we're going to protect our cash if we're doing seller financing and putting cash on the line. Trust me, there are ways that you want to look at that and analyze that to see if you're protecting yourself. So one reason that seller financing wins is low to no capital. You're able to get in with low to no capital, and I know that probably resonates with a lot of people watching right now. Another reason is high LTVs. If we've got a low equity deal, something where the house's ARV is 100 and this person owes 85 on it, the cash buyers out there aren't going to be able to make an offer. That makes sense. But we as seller financers are able to make an offer and, by the way, turn a 6-figure profit off of that deal that only had a $15,000 spread in equity. And that's a real number. If you run the numbers, you're probably pulling $112,000 profits off of a deal that you're buying at 85, 86%. Now, that being said, it's over time value of money, all that kind of stuff. I get it. But at the end of the day, it's a lot of money that you're going to be making.
And real quick on that higher LTV, one thing that is, I like to make the obvious comments because it's like, oh, Ryan's smart, although he's just saying really obvious comments. When you go into the higher LTV, guess what you're dropping off? Every time you go up a percentage, you're losing a tremendous amount of competition. So if Ryan Buyer is all at 75% minus repair, but Grant is buying at 76, he just lost me as a competitor. But then if Travion's buying at 80, well, Travion just kicked Grant's butt, because if you've got a seller, of course they're going to sell to Travion over Grant, because they're getting 4% more offer.
And that leads beautifully.
That's what I'm here for.
Into rule number 3.
Segue.
Item number 3 as to why seller financing wins is that even in high equity scenarios, we're able to cut the knees off of everybody else's offer, because if we can offer a low equity deal, no one says that it's low equity because the seller owes that much. If we can make those numbers work for us at 85, 86, 90%, then let's make those numbers work for us regardless of their equity position. Maybe they walk away with more money that way. So let's look at like a typical scenario that we might run into in $100,000. I always use $100,000. I know $100,000 houses get harder and harder to find depending on what market you're in, but it makes percentages easy, and I'm not a very smart guy. So if we've got $100,000 ARV on a house, every other wholesaler, Joe Schmo, who's gone out and learned how to wholesale or flip off of some guru program online, is just one of the pack. You're just one of the pack making the same offer that everybody else is making, and there's 200 postcards on their dining room table that are making that same exact offer. Oh, you pay closing costs? Cute. Oh, you can close in 7 days? That's nice. So can the other 400 people that are on
so real quick on that, let's just read off a postcard from the air. I pay closing costs. I purchase estates. I close fast. 7 days or less.
We buy houses.
We buy houses.
By the way, have you seen that my Facebook profile page has a We Buy Houses page picture on the profile?
You know, it's just simple. So you got to be able to stand out. And again, especially if you call back to the head, heart, gut, if you've got somebody who's a numbers person, you know, numbers win.
Yeah.
And I do want to point out that Daniel has noticed that Mr. Grant Kemp has jumped on.
I jumped on the gray shirt bandwagon.
Bandwagon.
I thought about that actually on my way here. I was like, oh, me and Rai are going to be Twinkies today.
So real quick before we go, I just want to say, Dusty, thanks for watching. Wade, DeMarcus, Jeremy, Quentin, Shelby, Paul, Ellen, Eileen. Sorry. You know, everybody, thanks for watching. Let's see if we got any more comments in here or questions. Wade from Aguilan, hey. And then also, you know, tag people. If you are, you know, one thing I learned Monday from Daniel is you got to get aggressive with your audience. So if you're watching this and you're enjoying this, tag people that are in the industry that will enjoy and also get something out of this. Get them and share this knowledge, because the whole point of what we're doing is trying to get our message out there. Yes, we would love you to be subscribers of Propelio, and that's why we're giving this information away for free. Yes, we would like you to check out CreativeCashFlow.com. So if you're watching this and you're enjoying this, help us out with a share. It's almost criminal that on a video like this we'll get 2,000 to 5,000 people to watching when there's probably more than 5,000 investors in the United States. So Quentin say hey. Let's see if questions.
I didn't run into any questions. Yeah, so good comments here.
Well,
so
I will say we got some YouTube questions.
Okay, cool.
YouTube. Okay. Do you think a lease option would be a good deal on a sub-2 family house or 2-family house?
On a two-family house? Yeah, I mean, so that really depends on your market, and you know, I want to. That's kind of a whole separate topic in and of itself, the lease option stuff. It depends on your market. Here in Texas, you're not really able to do lease options for longer than 180 days, and even then you cap at 3 years. So it depends. If you're in another state, yeah, lease options are great. Contract for deeds are great. They are great acquisition models. They are similar to seller financing, but it is not necessarily a seller financing model. Mm-hmm. But it really depends on the deal. It really depends on, I mean, there's way too many variables to just say, yeah, like, do it. So you got to know the numbers.
And then another, seller financing and reverse mortgage, been trying to wrap head around seller finance.
Yeah, seller financing. Reverse mortgages are the one thing I've yet to find a way to buy with seller financing. Yeah, that's been a difficult one. If anybody has successfully found a way to do that, message me. I'd like to talk about it because it's an interesting.
And before we get back into the list, you know, where are y'all from? I know we got a large Texas audience, but every once in a while we get our Connecticut's, our Virginias, our Arizonas, our California. So please drop in the comments, both YouTube and Facebook, where you are hailing from.
Right. So
let's get back on it.
Getting back to it, we've got our first 2 rules of why seller financing wins: low to no capital, high LTVs. But because we're able to buy at those high LTVs, that also cuts the legs off of every other offer that's out there.
We already did that.
I didn't finish.
Oh, my bad.
So I wanted to actually finish that particular
butthead.
line. So we've got an offer where somebody else might be offering them $75,000, $80,000, something like that. Of course, you might start off with that offer because you want that big discount. But what you're able to do, and this answers Daniel's question of, are you buying off of, what was it? Do you buy off of amortized values or face value? Here's what you're going to do on an offer like this: $100,000 house. We can offer them $90,000. That 10% or that 10% right there gives us the spread that we need to make our money on it. It's going to net them the same that they would have walked away with if they fixed up the house, sent it on to the realtor, got it listed, and sold the property. They would net 90% of that sales price, and we're going to explain all that to them, and we're going to say we're going to net you the same exact amount than the most that you could get for this house, which is going retail. So I'll give you $90,000, and I'm going to pay you interest on it. I'll give you 4.5% for 20 years, something like that. If you do that, now you're able to tell them, look, from selling me this house, you're actually getting $136,651 for it, versus those other 400 people whose postcards just told you they'd give you $77,000. Which offer do you want, right? We have that ability through the amortized loan to give them way more than anybody can give. So even with high equity sellers, we have an offer that can cut everybody else off at the knees and make them decide to go with us because of his point exactly. Every time an offer comes in higher, they don't care who it is. Well, I say that. I've gotten a lot of offers accepted that are lower, but they don't care who it is. Humble brag. They just want to know. Yeah, that's super. What is a not humble brag? Just brag?
Yeah, just brag.
Bragging. They want that number, right? So you get your number offered. So there's our first 3. Then you start looking at all those principles put together. Well, if you know how to do seller financing and you know how to do low equity deals or high LTV deals or low to no cash deals, what does that mean that you're able to do? Mm-hmm. You're able to work with all these other cash buyers that are out there offering 75%, offering 80%, who cannot touch the offers that you are able to give. And now all of a sudden you become a tool for them.
And one thing on because we brought it up earlier with the postcards, is if they're getting postcards and they're getting direct mail, side tangent, if you're doing direct mail, if you're not spending $20,000 plus, just make sure you're doing highly targeted, because there's so much competition in direct mail, you're just throwing money away. But that said, with the postcards, if your seller is getting 10, 20 postcards that all say the same thing, and you come in with something different. Like if every postcard says AM, FM radio, and you come in with Sirius radio, they're gonna be like, oh, you're something different. Mm-hmm. So if you're coming in with a new strategy that they haven't heard before, they're gonna be like, oh, let me do this. So that's another competition, competitive edge.
Right, yeah, you are, exactly. You are separating yourself. Part of good marketing is you need 3 differentiators. And each individual one isn't necessarily going to be that you're the only one that offers that, but your combination of all 3 of those is what separates you from the pack. So if you're being able to offer a much higher offer is one of your differentiators, that's going to give you an advantage. But to this point that we've got all these other cash buyers out there offering the same offers, well, how many REI clubs do you go to? How many times do you meet other investors who are out there investing who have no idea how to do seller financing and no idea how to make tons of money on a 90% offer or a 100% offer, or a 105% offer, which is something that you can do with seller financing? Well, now you are a tool for them. You are now making yourself useful through not just direct marketing, which is what we're all very familiar with, but I've got 2 very distinct edges of marketing. We've got direct marketing, whatever that is, knocking on doors, postcard, whatever that is. And you've got social marketing. You've got the ability to go out there and talk to other people and let them know. You saw an example of me social marketing 10 minutes ago when I said, hey, I've got hedge fund buyers that buy at 90 to 94%. If you want a JV on a deal, bring it to me. That's one example of a social marketing.
And then another term on top of that would be social proof. So the seller, if he was able to get that seller to, they actually did buy my house. Maybe they don't need to know the hedge fund stuff details, but the social proof aspect of it. So if you could throw social proof through the social marketing and then also have all those strategies, it's all win.
So part of this social marketing strategy is when you've got all these other cash buyers spending all these thousands of dollars, sending out all this marketing, knocking on all these doors, making all these contacts, and they are having to throw away every deal that doesn't fit inside of their I buy at 75% or below box. What kind of freaking massive inventory do we have to work off of as seller financing experts at that point in time? It's ridiculous. I'll tell you right now that 90% of the deals that I've closed over my career have been from deals that some other investor passed up on because they didn't know how to properly negotiate this strategy. And when I say negotiate, not like, well, I'm going to convince you, but like navigate. Maybe that's a better word. Navigate this strategy, okay? So if you can learn that, here's the pitch. We talked about networking in one of our earlier on episodes. Here's what you're going to do. You're going to say, hey, Ryan, who's a cash buyer buying at wholesale. So what are you into? What are you doing these days?
I buy houses.
You buy houses? Okay, so you're wholesaling or you're buying cash, that kind of thing?
Yeah, I'm a cash buyer and I buy houses.
Okay, that's awesome. So what are you doing when you run into a property where your seller maybe owes more than you're able to offer or is unwilling to accept an offer that's as low as you need it to be? What are you doing with that lead?
I refer it to Grant Kemp at CreativeCashFlow.com.
Oh, well, if you're already doing that, then I don't need to.
The real answer is I follow up with them. And I hope and pray, and in the back of my head, chalk it up as a dead lead.
Right. And so that answer is always going to translate somehow in one way or another to I'm throwing it away, right? Somehow that's going to translate typically into I'm throwing it away, unless they already know how to do seller financing. And then what you're going to do is you're going to say, okay, well, here's the thing. I actually specialize in low to no equity deals. I actually specialize with seller financing where I can turn a 90% deal into a ton of money. So if you run into those sellers, here's what to do. If you just give me a warm handoff, a warm handshake, ask them first if they're willing to sell for what they owe. If they are, I got it, no problem, we're closing that deal. And if not, ask them if they're willing to take their equity in installments. If they are, I got it, no problem, we're closing that deal. But even if not, let me know about that, pass that over to me, I'll run the lead, I'll do everything, and then I will pay you for that lead whenever we close on it. And this way, here's the key, you're paying for your marketing campaign out of your trash can.
So what Grant is just saying is a huge nugget, golden nugget. Travion, let's golden nugget that thing. No deal is dead until it is dead. And I know that sounds ridiculous, but obviously you don't want to waste your time on trash. But if you've got a seller who is communicating with you and working with you and y'all just can't get the right details, use your network. That's why networking is so important. You need to find some of your network. You need to find yourself a Grant. You need You need to find yourself a Grant. You need to find yourself a Daniel. Find your experts that their brain will figure something out. And you need to attach yourself to them. It doesn't have to be every deal, but if it's a dead deal to you, why not use somebody else as an opportunity, and maybe you learn something out of it, and maybe you get paid out of it. So your networking is so big on that. And real quick, since I've got the microphone, I do want to go back to the whole social proof aspect of it, because one thing I see a couple people doing really good at, and I see the majority of the people doing the other, everybody likes to post their checks of how much money they made on their deal. There are a few people, Quentin from San Antonio, Quentin Flores, he's really good at this. Instead of taking the pictures of the checks, he still does the checks, but he also takes pictures of the people he just helped. So the social proof aspect of it is if you can fill your Facebook page, your website page of all the people that you are buying their house from, when somebody researches you and they're like, oh, look at how many people this guy has helped. Obviously, you need to get a marketing release. I'm not a lawyer. I'm not a financial planner. I'm a CPA, but get a marketing release. I would recommend going the route of getting the social proof aspect of the people that you're helping versus posting the check. That's my soapbox. Let's get back to you. Sorry.
So, no, that's cool. So when we look at that, we've got just to recap, we've got low, no capital, high LTVs, high offers, and then we've got free leads. If you know how to do seller financing the right way and you can socially market and help other people close on deals that they are not able to close on and pay for their marketing campaign out of their trash can, guess what you just got? Free leads. You got leads that you did not have to send the marketing out for. You did not have to pay for any of that. You did not have to spend the time. You have a warm handoff.
Yeah.
And it's phenomenal. So free leads is another great thing that seller financing has that wins.
Yeah. And if you're paying attention earlier, I was talking about direct mail marketing. If you're not spending at least 20 grand, you're not even in the ballpark. So that's what he's talking about. Real quick, Eric Cooper from Lubbock. What's up, man? Thanks for checking us out. Bridgeport, Connecticut. Thanks. Blaine, how is seller financing good for the seller? Sounds like it's just the seller taking a risk while the buyer pays a premium that only makes you guys money. I will say we've done videos on videos, but if you can give us a 30 to 45 second answer.
Again, we'll exactly that. I can answer that like with a real quick elevator pitch, but please go to facebook.com/Propelio app because this is episode 31. We've probably got 6 other videos in that series of Grant Teach Me Something that address this like in detail.
Over and over
again. So the point is that we're able to offer the seller higher LTVs. I mean, just right here. In what we've talked about today, you're asking, well, why is the seller accept? Well, what if the seller owes 86%? They cannot sell it to a cash buyer. We're able to give them a way out if they're at that low equity position. If they're not at low equity and they've got high equity, we're offering them interest so that they're actually making more money. You heard me say, somebody offering accepting a 90% offer from me is making $47,000 purely in interest from my offer versus somebody coming in at 75%. So they're actually making, what did I just say, 75,000? Or I'm sorry, no, 75 is what somebody else offered. So by accepting my owner financed deal, they're actually getting an additional $61,000 in cash by accepting my offer over somebody else's. And then if we were to stop paying, you mentioned their risk. They do get a deed of trust from us. They are able to foreclose on us if we were to stop paying, which would be the dumbest thing in the world because the hardest part of this business is getting the asset. But if you stop paying, they get to foreclose on the property. And now all of a sudden, values ideally will have raised because, even in drops, like it eventually goes up higher than it was before, kind of like the stock market. Ideally, by that point in time, their property values will be higher than they are today. They will have had interest paid to them for like 5 years. They get the property back, and now they're in a position where they got 5 years worth of interest. Their house is worth more. They're able to sell it. They're in a better position, or they can rent it or move into it. So we remember when we talked about worst case scenario? Their worst case scenario is better than the position that they're in right now. So why wouldn't they?
Yeah. Speaking of worst case scenario, Carrie, divorce sometimes screws something up. Grant has actually talked on the show before where he's literally had a situation where there's a divorce on a sub-2 deal, and one of the divorcees was actively calling the bank to get the whole thing blown up and get the due on sale clause called.
Yeah, she didn't care it was going to ruin her credit. She just wanted it to ruin his.
She wanted to destroy her husband. So, Carrie, you're absolutely right.
But the point on Carrie's thing where it's like she can't get signatures, you have to have signatures. Yeah. You have to have signatures from both parties that are on the deed. Unless, if it's in a divorce, you have to look at the divorce decree because oftentimes the divorce decree will give the property ownership to one of the two parties. And in that case, that's all that they need is that party can do it. I know. And then on to Anna's question, what is the process of referring a seller? Paperwork to make sure we get paid for that referral. Let me just say one thing on that note. So yes, there's two sides of this coin. Yes, always make sure that you're protected. It doesn't matter unless it's in writing. Okay? Flip side of that coin is if the person you're working with has a good reputation in this business, don't get so stressed out about like, I'm gonna get mine, that you don't get a deal done.
Yeah, I'll say this, I think real estate investing is still very wild, wild west in a way. Grant is absolutely right. Protect yourself wherever you can with writing. That being said, handshakes mean a shit ton.
Oh my gosh,
They just do.
And you will be ruined in this business if you ruin one handshake.
Right.
That's one of the reasons why if you're working with somebody who's been around in the business for a while, I might have some paperwork somewhere that details.
Well, here's the thing is like, say you throw it, and I'm not all high and mighty, but it's just like when you are an active investor, you're busy. You have a ton of things going on. The only reason Grant's here is because he loves us, and why not? If he wasn't here, he doesn't have time to fill out a referral form, I sign this. So if you hit me up and like, hey, I've got a deal for you, can you sign this? I'm be like, you know, not to sound like a douchebag, that's a waste of my time. I'm sorry.
Yeah.
If the deal's big enough, well then yeah, that's a different story.
Right.
If it's $1 million deal, yeah, I'll sign anything you want. But for a $20,000, $30,000, $40,000 flip or whatever, yeah.
Yeah, and so yeah, exactly. Again, we're not lawyers, we're not giving you legal advice, but I'm just telling you, conventionally speaking, here in the business, I think I may have signed a document like that on one property ever, and we've done.
Yeah, I will
lots
say
of
for someone like Grant, for someone like myself, for someone like Quentin, because I said earlier, or Bryce, or
anybody
Gerard,
that you,
or your Daniel, or whoever that we talk about a lot, our reputation is far more valuable
than
a
$5,000, $20,000
or
thing.
$2,000, $3,000 referral fee.
Yeah.
Trust me on that. It just is what it is.
But if it's a newbie that you've never heard of and they haven't done a ton of deals, it's probably a good idea.
You shouldn't be referring to them shit anyway.
Well, that's a good point. Good point. Okay, so let's get back into here. So we've, and then we'll address some questions here in a second too. So we've hit low, no capital, high LTVs. We can offer high equity sellers better offers. We get free leads. That's a huge one. And if you look at the conventional world, how are these cash buyers buying? Okay, so part of what we've been talking about is that we're swimming upstream. We're taking deals that other people can't take. How are the other people buying this house? Okay, well, wholesalers are assigning that over to a cash buyer eventually. But how's that cash buyer buying it? Well, the cash buyer is buying it either by, like you mentioned, well, what if they've got all the capital in their bank and they're just buying it with cash? Okay, so that's one way. They're using their actual cash and risking that. The majority of the time, though, is that that cash buyer is personally signing on a loan somewhere, taking personal recourse, saying, hey, if I don't pay you back for the loan that you're going to give me to buy this house, then you get to come after me, kill my credit, all that kind of stuff, the majority of the time. Oftentimes, you can get blanket loans from like community banks and stuff like that, but even then, you're personally signing on that loan. It's very rare that you're getting a non-recourse loan from somebody to buy a house with cash. Mm-hmm. By using a seller-financed strategy like this, you have unlimited, non-recourse, non-institutionalized money for your deals. The only thing that it takes for you to buy a house with seller financing is a silver tongue. The ability to talk to the seller and let them know that you're the right decision for them right now, today, to sell their property, and that you're going to pay them over time. You're not taking your bank statements to anybody and getting approved. You're not taking tax returns and filing financials and sitting in front of a banker and waiting for their underwriting department. None of that. You're talking to a seller, you're telling them you're the right decision, and they're going to give you that loan. Now, if you look at like Fannie Mae, Freddie Mac, what is their cap? They cap at like 8 or 10 properties, right? Whenever you're doing investment loans.
It used to be 10 and they changed up, and I don't know what that changed was.
Yeah, I don't know where it is, but somewhere around 10 properties. We have months that we're doing 10 or 15 properties. You know what I mean? Like that's not, so again, we've got unlimited, non-recourse, meaning it's when we sign our contract with our seller, that is signed to an LLC. An LLC where only the LLC is responsible in the worst case scenario, which I've never had anybody foreclose on me. And I again, like I mentioned earlier, the dumbest thing you can do in this business is let somebody foreclose on you, because the hard part is getting the asset. Right. But worst case scenario, all your buyers, all your renters, all your whoever disposition model that you're using are in Cowboy Stadium, and a meteor hits it and none of them pays you, and you can't afford to pay $80,000 a month in debt services, and you have to drop one of these off. In that worst case scenario, that seller forecloses on you. They're foreclosing on your LLC. Your personal name doesn't get touched. Your personal credit doesn't get touched. So now you've got unlimited, non-recourse, non-institutionalized. You're not sitting in front of a banker. You're not getting underwriting departments. You're not talking to Fannie Mae, Freddie Mac. Lending. All of your deals can get funded this way just from, hey, can you sign this contract saying that I'm going to pay you $90,000 over the next 20 years? Cool. Done.
So on that, just because it ties into Blaine's question on YouTube, and no, Blaine, we weren't laughing at your comment. We were laughing at somebody else's comment. Oh, yeah. But he was asking what happens when the buyer, as in us, doesn't make payments, the seller is still responsible for the mortgage, and there's no money to pay it. We've actually addressed this a lot, and he actually just addressed it in that mini commentary right there. But the short answer is this: if I, as an investor, am spending money for marketing to acquire asset, spending my time, having my team to go get this asset. Once I've gotten that asset, and yes, say it's one of Grant's models where there's zero down and I'm just taking over or making payments on their behalf, like you should be saying. But maybe you still have to drop 5 into it. Maybe you drop 10 into getting into repairs. Maybe you're spending several $1,000s to market it out to find you a buyer on that house. The point is, you've spent money and effort to get that asset to a point where it makes you money. Why would you ever let it, default? But at the end of the day, worst case scenario, shit hits the fan. They always have the ability to foreclose and get that asset back, most likely in a better condition than when they sold it. So that's the answer. Again, the answer is, why would you ever let that happen? Worst case scenario, they get it back, and then they can resell it, probably make it better off.
But again, it's non-recourse to you. You have no personal liability on that.
Do you have anything to add?
No, I think you hit it. Yeah.
All right, cool.
Yeah. And just so that we can hit another couple of questions here, where was it that I just saw? Carrie asks, what if the ex-wife signed a quitclaim deed over to the husband? Does that count? It depends on what state you're in. You need to refer to an attorney on that. Quitclaim gets used a lot in Texas, not valid in Texas. So, you'll see that pop up. I'm not an attorney, again, full disclosure. But talk to somebody like Matt Aycock. He's brilliant. He's just one of the sharpest attorneys out there for Texas. Really, it needs to be in the divorce decree, but any kind of deed from the wife to the husband, whoever's on current deed, that's who you need to have signed on this kind of situation. Jeremy asks, is your primary marketing pre-foreclosure? That is one of the more successful areas that you can market in. We're actually going to address that here in rule number 7 here. And then Chris says, what about absentee owners with loans originated in 2000 on back? Guys, this is a blanketed seller financing. Why this is positive, right? Like, yes, of course. Like, we can go into tons and tons and tons of subsects that are going to work well with seller financing, but today we're focusing on why seller financing just in general.
And real quick, Blaine, just to, because he had restated. Actually, our first video that we've ever done here, we talked about the 2 LLC system, because what he was asking is if your buyer doesn't pay. Well, if your buyer doesn't pay, no, your seller is not screwed because you still have a vested interest to keep that asset rolling.
Correct.
If you do a 2 LLC system, which we have a full video, it's our first video we've ever done. Check it out on Facebook. I don't think it's on YouTube, but we'll figure it out.
Facebook.com/Propelio app.
There you go. Basically, you set up a 2 LLC system where you can foreclose on yourself to expedite the foreclosure process, get that buyer out of there so you can get somebody else in there before you're having to come out of pocket to keep those payments current. So, but no, you never, if you've got an asset, like we said before, why would you ever let that?
That is the silliest thing
go
there.
to foreclosure.
And guys, I love these questions that are coming in. We've got a lot of great questions that are evidence that I want to tell everybody on Facebook.com/Propelio app. If you click on the videos, there is an entire section called Grant Teach Me Something, where a lot of these questions are getting answered like in full detail for the entire video.
But that being said, feel free to ask them.
No, please. Oh yeah, that came out wrong.
Don't be a dick.
I'm not trying to be a dick. I'm sorry. I'm just saying, like, you can get, like, if we're answering too sharply on these questions, please go back and watch the full videos, because they are good questions. These are phenomenal questions. For instance, the question that came up with Justin, and I was trying to find the specific video. In the owner finance scenario, will the seller be able to purchase another property while under contract with this property, assuming their situation improves over the course of your contract? The short answer of that, which I will lead you back into, go look into the benefits of sub 2, which I think is around episode 20 or something like that. The short answer is, if they would have been able to get a loan without this loan that you've taken over on sub 2 in place, they're going to be able to get a loan with it in place, most likely. But we can't promise anything. We can't promise. We don't have a crystal ball. We don't know their credit score. We don't know anything. We can just tell them that our sellers, historically speaking, I've had sellers go out and get a loan the same week, the same month, all that kind of stuff. And it used to be, up until about 2014, that they would treat 30% of whatever that loan was that we were taking over on towards our seller's debt to income ratio when they were trying to get a new loan. Now, the underwriting guidelines say if you prove that somebody else is paying that mortgage for them, then none of this sub-2 loan gets counted towards their DTI. But again, we go into that in more detail in some of the other videos.
And real quick, only because this is our first time we've ever gone YouTube Live, I'll give the guy a plug. Jason Blake on YouTube buys notes. So if you've got a note to sell, look him up in the comment section of YouTube. And on that, we will be doing 2 book giveaways. We'll do a comment picker for a random comment picker for YouTube. So the 4 of y'all on there, you get a high probability of winning a book there. And then obviously Facebook as well. We'll do our random book comment picker. So what we do is for every comment you drop, that gives you an opportunity to be in a contest, and we'll think of a book here because we like to educate and get smart.
Yeah. All right, so let's hop back in here to our why, 7 reasons why seller financing wins. 1, low to no capital. 2, high LTVs. 3, we can offer even high equity sellers more. 4, free leads. 5, unlimited, non-recourse, non-institutionalized money. 6, let's think about this. When you are buying with cash, this kind of goes back to our very first point, right? When you're buying with cash and you've got to buy at your discounts, all that kind of stuff, well, you're putting cash on the line. I don't care if it's your cash or a lender's cash or somebody, however that cash is happening, cash is changing hands. There is cash on the line. When you're doing that, you need to buy a title policy to protect that cash. Just like you need to buy at a discount to protect that cash, one of the things you need to do is buy a title insurance policy. Well, what is a title insurance policy? We're all familiar with closing through title. This goes back to the whole principle of like we need to know our rules and why those rules exist so that we can know how to accurately break them. Same thing with our rules of thumb. Well, the title insurance policy, you should know that every title company, the title company is just an insurance company. The title company that you're closing with, they make their money from insurance policies. They make a little bit here and there from like escrow fees and stuff, but the insurance policy is what keeps that title company afloat. What happens when you close is that you're going to show them your file. You're going to say, let's open title. They're going to go out. They're going to search the title records, the public records, and they're going to say, like, okay, title changed from this person's hands to this person's hands to your seller's hands. That all worked accurately. I don't see any other debts on this property. No mechanics liens, no judgment liens, nothing like that. You've got a free property or a property that is totally free of liens other than the loan that they owe to their bank. So therefore, when we close on this, we're going to pay that loan off, and you're going to get a house that has no encumbrances on it, no liens at all. Okay, that's what happens there. And then what you're paying for in the title policy. Sorry. You're making fun of my voice. Paying for. What you're paying for in that title policy is them saying, but if for some reason we missed something in our search and we just straight up missed it, we didn't see that this was out there, we'll pay for that error. We will pay whatever that lien is. That's your title policy. Okay? So let's unpack that again. The reason why we're doing that is that we've put a bunch of cash on the line. And when we buy that house, we want to have that cash that we've purchased the house with in first lien position, or if we're just paying all cash, which I don't recommend doing, then you've got no liens on the house. But you want essentially that first lien position. Rai, what gives us first lien position? People are gonna start calling you Rai, and it's my fault.
Hey, I like Rai. The lien position is when you file.
Right.
So if I give you $100, or not give you, if I loan you $100 and I'm first, I'm first lien position.
Right.
And then if Travion comes in and gives you
$200,000,
but he's second, he's second lien position. So lien position has nothing to do with the amount, it has to do with timing.
Perfect. So it is only the date and time in which it was filed. The reason why this matters is that in that scenario, Ryan gave me $100, Travion gave me $200,000. If I stopped paying Ryan's loan, he gets to foreclose on me and get that property back.
Woo!
And as a first lien position, if he forecloses, every lien that's downstream from him is kaput. They don't get anything, completely wiped out, all gone. He gets a house lien free.
I think in that scenario, Travion's going to come and break your knees or something.
Right?
He's going to get his
Yeah, I'm gonna get mine.
Yeah.
So so in this scenario, that first lien position for $100 got the house and wipes out all the subordinate liens. That's very important. That is why a title policy is so important, because if we buy a house and we put a $75,000 loan on that property and we expect that loan to be in first lien position, and then lo and behold, some mechanics lien pops up that got missed from a year ago. Well, if it was filed a year ago, what matters in a lien position? Time and date. If it was filed a year ago, then guess what? It's in first lien position, and now our $75,000 is at risk at being wiped out if that guy decides to foreclose on us. So the title policy is just going to go ahead and pay that for us, wipe them out, and then yes, we still have our first lien position.
Can I throw in a side nugget?
Sure.
So when negotiating deals or potential deals, or you're looking at a prospect and it's a dead deal because it's got a first, a second, a third, a fourth, and all their liens stacked up, it's $1 million, but it's a buy at $150,000. One of those negotiating strategies, or one of those ideas that most people don't think about, is why not contact the second, the third, the fourth, and be like, look guys, you're about to lose everything. So why not negotiate down where you at least get something? And that way, maybe that $150,000 purchase, you could still get across the finishing line. So just because I know everybody's familiar with short selling, a mortgage, well, you can always negotiate these second, third, fourth, fifth, whatever, to get a deal. So just keep that on the table, because again, as a typical wholesaler, they're going to walk up, well, shit, this ain't a deal. They owe $1 million. It's only worth $100,000. They're just going to walk away because it takes work. So, but there was a Henry. He used to watch us while I think he found a girlfriend, and we haven't seen him ever again. It happens. If you're watching, Henry, we miss you. But he was really good at being able to hit up those second and the thirds and the fourths and get them to accept literally pennies on the dollar, because he was able to convey to them that, guess what, you're about to lose everything. So just keep that in mind next time you're looking at a deal, and it may look dead, but if it's got those second, thirds, and whatevers, why not reach out and try to negotiate it down?
Right. So we've got some questions popping in, but here's what I want to do. I want you guys to keep up with us, keep tuned in, because I want to address those at the end. Let's kind of stay on track for a minute, and then
My bad.
Well, no. You're not my bad. You weren't even saying anything. I'm just saying, there's a couple of questions that might take us on tangents over that we're only 2 points away from finishing up this thought. So we'll stay tuned in. I will address those questions. So, in this title company, or this title policy thing, right? We're getting a title policy because it's ensuring that if a lien pops up later, our title policy will pay that off, and then we will retain first lien position. Just like our discount exists because we need to protect the actual cash that's on the line, so does the title insurance policy. That exists so that we are protecting the cash that's on the line. If we are buying a house with little to no cash on the line, we have nothing that needs to be protected.
On the line?
On the line.
Okay.
We don't need to protect that cash that's on the line because there's not much there. So we might be buying houses that by the point in time that we've actually closed on our front and back end, we may be at a net negative $2,000, $3,000, something like that, right? If that's all we've risked, why are we going to spend $1,000 or $2,000 on a title policy to protect our $1,000 or $2,000 in cash? That's a huge portion of what it is, right?
Real quick, again, disclaimer.
I'm getting there too.
Not a lawyer,
right.
Not a financial planner, not a CPA.
Absolutely don't go out there, not get a title policy, lose on the deal and say, but Grant told me not to get a title policy. Get the title policy. If you are uncomfortable with this risk at all, please just pay for the title policy, call it a day, right? I'm just telling you what I do. Please don't just take this at face value. Like, if you have any uncomfort with it, just pay for the title policy.
In everything about real estate, trust but verify. Period. Grant may be the coolest, sexiest man alive. Trust but verify. Because Ryan might be full of shit. Well, that's true, but trust but verify. Anyway, all I'm saying is you can love somebody and respect them and think they are the bee's knees. Trust but verify.
So here's the other thing that I want to use as an example, and we'll pop this in here. Comment on this message if you have ever actually had to do a title insurance claim. Okay? Comment there if you've ever actually had to make a title insurance claim, and if you did, tell us for how much it was. And I can say that because Fred isn't watching.
That's the only person I know either. Side tangent, because I know you love side tangent. Fred bought a house from a dead guy. Well, actually, he bought it anyway. The house itself was sold by a murderer, and the guy and his. This is not funny. That's so bad. Anyway, he bought a house, and in the middle of the rehab process, they found the previous owner under the patio.
Yeah, it was a tough situation. And that is the outlier by far, right? So he always ruins this example whenever he's watching. He's like, well, I did one for $250,000. But the point is I said that a few minutes ago, we've got nobody commenting here. Did anybody say on YouTube that they've ever had to make a title insurance claim? No. How many title insurance claims do you think have been bought cumulatively by all of us watching? Tons! Tons of them. Tons of title insurance policies. That's how title insurance companies stay in existence, is that they're banking on the fact that we're never going to have to actually make that claim. Now, 99% of the time, you will not have to make a claim on a title insurance policy. Okay, so Jeff says plumber's lien that didn't show up in closing. Comment on how much that was. How much was that actually claimed that needed to be made? 99% of the time, title insurance, you will never have to make a claim. Of that 1% of the time, 99% of that, the title claim is going to be for under like $3,000.
And again, this goes back to the overlying theme of this entire episode when we start at the very beginning, which is you have these unspoken, spoken, arbitrary rules that are the standard. And why not break those rules?
If you know why they exist, then you know how you can break them.
Or manipulate or bend.
So again, if we look at that, 99% of the time a claim's not going to happen. Of that 1%, 99% of that time, that claim is going to be for under $3,000. If you're paying $1,000 or $2,000 for every house that you close, and you close 20 houses in 1 year, you've spent $40,000 in title insurance policies that you're probably never going to use. And if one of them does have to get used, and the likelihood is it's for a $2,000 claim, well, guess what? You spent $38,000 that you really didn't need. Oh, good. Perfect example. Jeff Steele, around $2,000. Okay.
I will say this, just to put a wrench in your whole example. Say you're Elizabeth Navarrete in Houston and you're only doing $1 million deals, and then randomly they miss an air on a property.
Well, but how much cash did you put up on it, right?
Well, I'm just saying, it's when you're talking about $1 million property,
right?
That's a lot of money.
It is a lot of money.
So,
but my point being is that take your own risk assessment and see what's comfortable to you. And again, if you've got a lot of cash on the line and you want to protect that, or you've just got a deal that you really want to protect, pay for the stinking policy. It's fine. It's $1,000, $2,000.
So what Grant is saying is, let it ride.
Let it ride. So if you are not paying for a title policy, that opens you up to closing not at a title company, but with an attorney's office. Okay, that is the sole deciding factor of if you're going to close at a title policy or a title company versus an attorney's office is, are you buying a title policy? If you are not buying a title policy, you cannot close at a title company. They will not close you. You're going to go through an attorney's office, but you just saved $1,000 or $2,000 on your closing costs. So we look at our rules here, and I'll tell you myself, I buy owner finance properties all the time. I never do title insurance policies. I've had to pay one lien one time. Actually, no, that was at closing. That wasn't even something that would have been a title insurance claim. So I've never had to make a title insurance claim in hundreds of deals, and I've saved tons of money by doing it that way. So you look at another reason that our sixth reason why seller financing wins: cheaper closing costs. So you've got low to no equity, high LTVs. You can offer high equity sellers more money. You get free leads, unlimited non-recourse, non-institutionalized money, and cheaper closing costs. Now, to directly play into that point of cheaper closing costs, like I said, we're closing at an attorney's office versus a title policy. Do you know why it is that title companies need that like 7 to 10 day range for closings?
Golfing.
It's because they're getting that title policy ready. The reason why you need that 7 days, or even some title policy, it depends on how busy the title company is, but you can get it.
And a lot of it is due to the 2 to 3 day window at the beginning where they have to research at the plant and all that BS.
Exactly. So all of that delay in closing comes from the title insurance policy technicalities that are going on in the background. You can get them sometimes as early as 4 days, but typically they want 7 to 10, maybe even 14 days to close out your deal. If you're not getting that title policy, you can close through an attorney's office and get closed like that. I've literally had deals where we got Monday, foreclosure is Tuesday. We got it Monday morning. We did the title search, which the title search that the title company does literally takes like 3 hours. You get that same title search done from an attorney's office, you get the abstract of title, you get all the information, you make sure that the title is clear, okay? You can get that done in 3 hours. You can get doc prep done if your attorney is good and working with you and you're sending them a lot of, enough business. Don't count on attorneys getting same-day turnarounds for you, but when you're sending them a lot of business, they're willing to help you out some. I've gotten leads in Monday morning, gotten the title search done, the abstract of title looked at. We made sure that we were in the same clear position that a title company would have given us. We're just not buying a title policy, and we closed on the deal, took it out of foreclosure, all within 24 hours.
So to dumb it down for Ryan speak, it's basically you got Google and then you've got verified insured Google. You're still going to get the same results.
Google being the search on title.
Right.
Yeah.
Like everybody can use Google and research and use the tools to get that information. The only difference that a title policy is they're going to insure that search.
Right. So there you have it. There you have 7 reasons as to why seller financing wins.
What was 7?
Faster closings.
Oh.
You can get closed.
Cheaper and then faster.
Yeah, it's cheaper and faster. It's cheap and fast, just like my ex-girlfriend.
So ladies and gentlemen, Grant Kemp. Just to recap the summary before we jump into the comments, again, if you have questions, if you have comments, Facebook Live, YouTube Live, the reason we do this live and not pre-recorded is because we want this to be a community effort, we want this to be an exchange, and we want this to, we want the engagement. We love to see the likes, the shares, the hearts. Mm-hmm. So that being said, give it likes, give it shares, tag people that you think that need to be watching this.
Right.
Share this on LinkedIn, share this, whatever. But we want the shares, we want the likes.
And for my sake, check me out at CreativeCashFlow.com. Check out at CCF Mentors. We're linked in the description of this. If you like how I'm describing things, you like the fact that we're looking at things that are outside of the box and ways to buy houses that not everybody else knows how to buy. That's all I do, is I teach people how to do that kind of stuff.
Somebody tag his loose and fast.
My loose and fast ex-girlfriend.
So to recap, what we got: the seven reasons seller financing is winning. You've got low to no capital. You've got being able to buy at high LTV. The third is the competition aspect of it. 4, you've got free leads from the networking aspect. Number 5, you've got unlimited
non-recourse,
non-institutionalized bukus of money. Number 6, cheaper closing costs, and number 7, faster closing costs. I did that to prove to Grant that I was paying attention.
That's excellent. And that faster one is huge, because especially with pre-foreclosures, you guys know, like, you need that deal to come in like a week or 2 before the auction date if you're going to close with cash, whereas we can get deals like a couple of days before the auction date and close it with subject to owner financing and get that deal done. And might I throw a PS in there that I'm not even addressing today, but to your point of what you were talking about, like, we're seeing a little bit longer days on market, I don't expect a crash, I expect it to be a slow taper, but here's the thing, and I'm going to steal this phrase from the great Mitch Steven. I love Mitch Steven. He's a super sharp guy, one of the few good ones that I will recommend as far as owner financing. But his phrase is, look, I'm not saying that owner financing is recession-proof, but what I am saying is that if there was a recession-proof strategy, this would be it. We actually do way better in a recession. We buy tons of houses, we sell tons of houses in recessions. That is when we shine. So right now, as we are peaking, right now is the time for you to go check out CreativeCashFlow.com, to go learn how to do these things, not so subtle plug, to go learn how to use these strategies that work so much better in a recession, so you're not that guy or that girl when the market turns that loses everything. How many I've lost everything in a crash stories have we heard? Get ready for it. While it's still good, get ready for it, and then when it does happen, all you do is switch strategies and you're still making money.
Yeah. It's all Gary Keller. What is this book?
I don't know.
He did a book. It's called Shifting, I guess. I don't know, something like that.
You want to give it away?
Do you just I don't know it enough to give it away. Do you just market to low equity? That's from Jamal on YouTube.
No, and that's actually one of the things. So point 3 was that even on high equity deals, we're able to make a better offer. So yes, low equity is one of the differentiators. That's one of the things that we are able to do that other cash buyers can't. But even on high equity deals, we can make a better offer to them.
Mm-hmm. Do you want to help me find some questions here? Because I don't know where we left off.
Jeff brings up a great point. I've done this before. We helped a gentleman keep his retirement income by carrying the note for us. Where else are you going to get 6%? He couldn't be happier. I love this topic. Absolutely. I do that several times with people because here's another question, a pitch for giving somebody that does have high equity to tie this together is, look, if I gave you all cash, what are you going to go do with that? Are you going to go put that in the stock market where, yeah, today, sure, it's making 10, 15%. But if you look at any 10-year period in the stock market, you're averaging like 4 to 6%. Any of them. You just grab a 10-year claim, you're averaging 4 to 6% because the market does this, right? We can give you 6%, 6.5%, 4.5%, 7%, whatever. We can give you this percentage on this property, this asset-backed loan, on an asset that no one in this world knows better than you do. So it's protected by that. How is that not a better deal than hopefully losing it all in the stock market? Are you a stockbroker? Do you consistently get 30% returns in the stock market because you're really good at it? Or do you just know that the stock market is someplace to make money and you're going to be throwing it over in there? Well, why do that if you can make a better return, be asset backed, and a locked in interest rate on this?
Ace Ham, he has a good question, and I think both of us are answering just to get two different viewpoints. How do you convince a realtor to accept an owner finance offer when cash won't work? Here's the thing. If you are a realtor, you're going to have to figure that out on your own. If you're not a realtor, contact the seller directly. Feel free to invite the realtor to be there as well. And just explain to them, and this is, I mean, Daniel's talked about this frequently, just explain to them, it's like, look, no one else, you've got high days on market, nobody else is going to be able to buy it, I can give you the best option. You can listen to your realtor and not do anything, or we can do the deal, and just really try to explain and show them what you're up to. Not what you're up to in a shady way, but how you are helping them and assisting them, especially in a pre-foreclosure situation, because realtors tend to forget that, first Tuesday of the month, shit goes to auction. So the short answer to that is, if you're not a realtor, contact the seller directly and have that correct conversation directly to them. And yes, by all means, I'm not saying try to go behind the realtor. Have the realtor in the room, but you need to have a sit down directly with the seller.
Yeah.
How would you answer that?
Yeah. So if the seller has done anything, and I'm sorry, I'm going to be searching to try and find a video to answer somebody else's question. If the realtor has done anything to make that deal happen, make sure that realtor gets paid. Okay, that's one thing that I will throw out there. Like, if you find it from any marketing that they've done, if they're in, but if you find that deal from a direct marketing and the person wants to work with you directly, then maybe that person can cancel their contract with that realtor and work with you directly.
Yeah, and again, if they've got a listing agreement, I'm not saying cut anybody out of the deal, because that goes back to the reputation thing. If somebody deserves to get paid, they need to get paid. But I'm just saying in terms of explaining what you're up to.
Right.
You never want to cut anybody out of the deal, because you never know when that's going to come back on you tenfold.
Right. And so to that point, convincing realtors can be very difficult, to be frank, because the thing is that for whatever reason, realtors have been taught by their broker over long periods of time. Basically, this is how brokers approach a situation. If I don't understand it,
it's illegal.
It's illegal. That is how realtors have been trained from the beginning, is if I don't understand it, that's because it's illegal and we shouldn't be dealing with it. And that gets very difficult for us to handle, because that's not true. I can point to law after law after law that shows that we're able to do this. So realtors can stand in the way of this. It is a very difficult situation when there is a realtor involved to deal with this. So just keep that in mind. But just like you said, talking that out, making sure that everybody understands what's going on is so important.
And to reaffirm how closed-minded some of these situations are, or realtors can be. Again, there's plenty of new blood out there that are amazing. Jason, a quick shout out to Jason Riney. We were working a deal several years ago, and it had a listing with a family friend who was a realtor who was actually trying to be shady and snake the house on the backside. We come in there with a TREC contract, and she's like, "You're not a realtor. This is illegal. You're not allowed to use a TREC contract." It's like, it's on the TREC.com, whatever form. It clearly states anyone can use this form or this contract. Yes, there are plenty of realtor contracts that only realtors are allowed to use, but when it flat out says on the website that it's open to anybody and everybody to use this form. So again, some people are just so close-minded, and if they don't understand it, it's illegal.
Yep. Okay, so then we got another question about how do you convince, I'm trying to find that question, who I saw it.
Well, real quick while you're finding that, Joel, he has a terminology question, seller finance versus owner finance. It's literally as easy as it sounds. The seller finance is if I'm the buyer and Grant is selling it to me, he's seller financing to me. If from his perspective, he is owner financing to me.
Yeah.
So I'm looking at him
synonymous.
Seller financing because I'm buying it. He's seller financing. He's looking at it as I'm owner financing to Ryan.
Right. So it's a completely synonymous phrase. You're going to hear me use it inside and out. My copywriters get driven crazy by that and want me to stick to one term. But you're going to hear both terms. It's the same thing. Owner financing, seller financing. Those are both the same thing. It's just maybe looking at it from a different perspective. I answered that with the. Okay, so I have a home under contract right now. How do I sell it to a buyer as owner financed and make a profit? I just logged onto the show. Maybe you answered it already. My answer to that is going to be through like a wraparound mortgage. And I think if I can find where we might have talked about that one. I can't find where we talked about that one, but look through the Grant Teach Me Something videos on Propelio's because wraparound mortgages, basically what you're going to do is you're going to sell it with owner financing to a buyer for essentially a higher payment than you're having to pay. It's a pretty great way to go about doing that. Now, we had a question on here too, and I can't find it right now, but we had a question on here about how do we convince, from Jeff Montagna. What's the trick to negotiating zero down? So Jeff, I'm gonna tag you right here, Jeff Montagna, and I'm actually gonna put, like, I have a whole negotiations series, a negotiation quick tip series that you can get for free by clicking on that link, put your email, and I will send you negotiations tips on how to get that, because that's a whole topic. I mean, I got like a year's worth of videos on how to work that down. You can also go to Grant Teach Me Something, episode 4, and you have to say it like that too, by the way. Episode 3 is called the hairy arm principle. I'm also going to link to that because that is one of the primary ways that we will negotiate that zero down situation. So I just put those out there. So look at those, but the short answer is there's not really a short answer. It's a full-blown, like, negotiations are a big deal. I'm very, very big in negotiations because it's a science. And you've got to know what words get what reaction, what order to say things to get the contract.
And on that, maybe we should give influence?
Yeah, let's give influence. That's a great book for today.
Just because influence is a great negotiating book. Blaine on YouTube, what laws can you point to? This is where I'm going to be very annoying to you because I'm going to restate again. Neither one of us are lawyers. We're not attorneys. We're not offering legal advice. What I will say is whatever legal questions you may have, contact your local real estate attorney and ask them directly. Right. I know that sounds like a bullshit answer, but it is.
Well, it also depends on the state too. So like I can point to, if you give me 5 seconds, I can actually tell you what part of the Texas property code talks about wraparounds and how to properly do that, like in Texas, right? But the other thing that I want to ask you, and so this is where it gets it to be the difference between the default answer that we get from brokers of, I don't know how to do it, therefore it's illegal. One of the things that annoys me that I get from realtors is, like with some things they might say like, oh, well, show me in the law books where it says you can do that. So for instance, in the Texas property code, section 5.016, that talks about conveyance of a residential property encumbered by a lien and how to properly do that. So if you're curious about that, it's section 5.016 in the Texas Property Code that talks about that. But if you're out of state, I can't answer that for you. But here's what I'm going to return down to you, and this is what I've started saying back to those people that are so aggressive about that thing is, okay, show me where in the law it says that you can wave hi to your friend on the sidewalk. Okay? Sometimes it's much harder to point why you can do something. The only answer is, well, because there's not something that says I can't. All right? So show me in the law where you can wave to your friend on the sidewalk. You're probably not going to be able to find a piece of law that says, well, in the state of Texas, if you are on a north-facing street, you may wave hi to your friend on the sidewalk. But if there's not a law that says you can't, then you can do it.
I will say, side tangent, you could tell Thomas has watched a couple of these because he just did a callback to the hashtag rap donut.
Hashtag rap donut.
Rap donut.
Awesome.
Let's see, what else we got here before we
Jeremy,
call it a
we
day?
inspire him to be better. That's awesome. Thanks, Jeremy.
And then everybody on YouTube, it's the maybe it's because I'm doing it for my personal YouTube. It's not allowing me to drop in the link. What I'll do is once we've end this video, I'll throw a link in the comment section, not the comments, in the description, so you can go to the link that Grant was sharing.
Awesome. I think we hit all the questions on Facebook here.
Yeah, and again, I just want to say thank you so much for everybody watching. Make sure, again, call to action. If you haven't liked our Facebook page, what the shit? I mean, seriously, guys, help us out there.
We're classy around here.
I know, we're classy. Classy. Also, if you're watching on YouTube, like or subscribe, turn on notifications. Same thing on Facebook. Turn on those notifications. If you know people in the business that could benefit for what we're doing up here, tag them.
Yeah, please, if there's somebody that you've talked to, a cash buyer that's kind of curious about how this stuff works, I think this is going to be a really good intro video to what seller financing is and why you might choose to do that, right? I mean, because we've got we've got 30 videos on like technicalities of how certain things work, but like I realized I haven't really addressed like just a straight up like, guys, this is an awesome strategy and this is why.
We don't really know the order of things. We just start doing shit, So anyway, last chance. We'll give it about 3 more seconds for people to drop in those comments, drop in those hearts, drop in those likes, and then what we'll do is we'll do the comment picker both for YouTube and for Facebook.
And we're going to give away Influence, the Psychology of Persuasion, which is the cornerstone of my negotiating career.
Right.
When I started this business, negotiations were actually one of my weakest points. When I realized that and I got mad that I wasn't good at something and started studying it and figuring out how things go, Influence, the Psychology of Persuasion, that book turned it all around for me. That was the starting point to me opening my mind up. And a lot of the book is like, oh, that's why that works. And then you can apply that to other principles. So to answer your question about the negotiations, that's and Ryan just put a link to the book on Amazon for you guys to grab.
Or win.
Ooh.
So let me go here, and then let me grab this link because I know what I'm doing. Go here.
Time to give away. Get your comments in right now if you want to get.
Yeah, I'll say this. If you're watching on Facebook, because I know a ton of y'all do, you might want to head over YouTube and drop a hey.
Double your pleasure.
I don't know. I'm just saying it's out there.
Double your fun.
I'm okay with hacking the system. As far as what we got going on here, as far as cleaning house, whatever, we are in the process of trying to finalize dates for our events in San Antonio and in Houston. Looking at August 20th, 21st, 22nd, one of those. So we'll probably do a San Antonio, Houston like we did last time. I'm just waiting on the venue in Houston to be frank, I'm talking to a rental assistant, and I haven't been able to get a hold of the main person. He's like, well, it's a nonprofit. The committee has to give you approval. And I'm like, well, how often does the committee meet? I don't know. I'm like, come on, guys.
Do you know what I'm doing right now? What everybody else should be doing?
Is marking
my calendar for a tentative date.
Tentative dates.
20th to the 21st.
Monday, Tuesday,
somewhere
or Tuesday, Wednesday. That Monday, Tuesday, Wednesday, that's what I'm desperately trying. Hopefully by the end of this week we'll have firm, and then you will be spammed like no other of those events coming up.
Ed Chambers, thanks for logging in, Ed.
Two places at once. You know what? I am glad people listen. Jennifer Harris, hi.
Chambers.
It's always good when you put stuff out there and people listen. I'm actually surprised I haven't seen any hashtag find Miss Harper's on this live stream. So thank you.
Right?
I'm not desperate, I promise. Okay, cool. So you ready?
I'm ready. Let's
All right,
push the button.
Let's do Facebook first, just to give the YouTube people a little bit more time to double dip. All right, push the start button, and Ryan.
I've never won this.
Paul Shaw.
Paul Shaw, getting an excellent book.
Paul Shaw, if you would, sir, please send me a DM that's a direct message.
Ooh, using lingo up in here.
With your mailing address, and I'll get that order for you. Real quick. How many times, well, let's ask a question real quick. How many times have you or your LLCs gotten sued?
0. I'm trying to remember who started the suit on if I started it or they started it. Maybe 1 if they started it, but I won. So I don't know if that counts. I can't remember who sued who on that.
Let's use that for the opportunity just because Blaine is on YouTube and we've never done the live. When you go into any kind of suit in the investment world, you need to make sure you follow the CYA all day long, because anytime you're going to be in front of a judge or a court of your peers, you are always going to be the big bad scary investor person.
And let me just say too, because I know the YouTube channel people may not know me or us yet, like I am a huge stickler on do the right thing all the time. Like that might be something that a lot of you are being introduced to right now. I am very far away from just get it done because who's going to sue you. I'm very big on we need to be like, I mean, you saw me, I pointed to a piece of law that says why we can do that like that, right? So I'm big on do the right thing. One of the things that we put in every one of our companies, because I own several companies, that all of them have the brag. I'm going to just put out humble brag, just brag. One of the things that we put in all of our mission statements is that we're going to do the right thing, especially when it's not in our favor, okay? Because that's true. We have to be able to, I don't care about facing the judge, I care about facing ourselves. I care about facing the fact that we're gonna do business the right way. There's a lot of snakes out there that are trying to get away with things and are getting away with things. That's not how we're gonna do it. So that's why you'll see a lot, like I've even got compliance episodes on here, like we go into that. So yeah, even if you get sued, just because you're doing things the right way doesn't mean you're not gonna get sued. But if you do get sued, you better be able to win.
Yeah, the biggest thing is don't be a dick. We talk about that a lot. Don't be a dick.
I like how we both have the same mission statement, but like yours is
mine's like,
don't be a dick.
Wait, that sounds bad. I said mine's like this.
Moving on.
Anyway, my message. But one thing what he's talked about is, say his sub-2 contract, it's like 30 plus pages, but every other page is why you should not be doing this deal. Or, and maybe not that. How do you put it? It's
well, half of it protects you, half of it protects me.
Right, and that's how all your things should be, is be above board, because your reputation is not just within the investor community, it's within all the community. Because guess what? Some Channel 5 reporter, gotcha segment, oh, he did this or she did that. It's like, but did I followed the rules. I tried to take care of them. And we have addressed this in the past where you can help people all day long and then they forget where they were in that situation where they needed that help. And then you're the big bad investor. So always CYA. All right. Cool. Live stream the event. We're working on that. So, okay. So YouTube peeps, let's see.
Who it be?
Whoops. Whoops.
What?
I don't know.
What?
Maybe it's this
We're
one.
working on it.
Hey, you know what?
In the meantime, just want to encourage you guys. Thank you guys again for being here. Like, it's so important that you're taking time out of your day to learn, get better, find about other strategies, all that kind of stuff. I mean, it's so important to know, again, the rules, right? Know the rules and why they exist, because that allows you to know why to break them. Because again, a lot of these rules that we were talking about are just conventional knowledge. It's not like a law or a rule. There's no law that says you need to buy at 75 cents. Conventional knowledge says 70 to 75 cents, along with lenders and all that kind of stuff. I mean, that is the protectionary method that we have in play to say we're comfortable with this investment because in our worst case scenario, hopefully we just break even. right? So that goes into play on that side, as well as like our rules of thumb. You're going to hear me in a lot of these videos, if you go back and you look through just the random, I mean, like I said, we got 31 videos in there. Watch through them. You're going to hear me reference rules of thumb a lot. You're going to hear me reference different reasons as to why we're doing things, because look, just because I'm saying you can buy at higher percentages, I do not mean, okay, you've got a house that owes $50,000 on it, so you're going to put $50,000 in cash in, or say $40,000 in cash in on a house that's worth $100,000. Yes, you're in 90%. Yes, you're fitting in what I said you can do, but that does not fit my 2 times cash rule. That does not fit my, if you're putting in and you don't have 2 times cash, then you should have that 82-cent rule. That doesn't fit those rules, so we're still not going to make that decision because it's still not wise. So don't just blanketly say, well, Grant said we can buy at 90% and make money. The terms have to still be right. It's all about terms. Always terms is the most important thing, more so than price or anything else. Is how are you arriving that price to your seller?
So our YouTube winner, it pays to ask questions. Blaine Winston, thank you for all those questions. I don't know if you can, just shoot me an email, ryan@propelio.com, or find me on Facebook, email's fine, or drop your email in the comment section and we'll connect, get that address and we'll send you that book. But anyway, hey, YouTube, thank you so much for watching. Facebook, thank you so much for watching. If you have continued questions, we actively monitor both. So keep those questions, keep those shares. Any final parting thought? Oh, well, shit, we do this to plug ourselves. Propelio.com. What Propelio is, we are a tech company. We offer off-market lead lists to investors. We offer access to MLS comps to investors, and we also are offering investor-friendly websites. We also do free education. August 1st, we're doing the soft launch of our Propelio Academy. October 1st is going to be the hard launch. So make sure you stick around. What the Propelio Academy is, or what will be, it's our effort to prevent you from spending $30,000, $50,000 on one of those fly-by-night guru traveling salesman programs where all you do is spend money and learn a little but not really take action. We want to give it to you for free and hopefully grow and really help you take action to succeed this business.
I liked how Daniel put it when he said, if you have the opportunity to change somebody's life, how much do you have to charge for that?
Yeah,
right? And so
like
to him, it's zero, and I think that's awesome.
Yeah, after you say something like that, you instantly feel like an asshole for any kind of reason you would do it.
Right, yeah. Speaking of, CreativeCashFlow.com.
Whoops.
I know, but here's the thing, is that I share the philosophy with these guys. I think that it is important. I hope that you can see through all of the massive amount of data and detail and stuff that we are giving away for free that I am providing here. I do want to see you guys succeed. That said, it is also a business for me. I understand that this is a marketable thing, and I do have a full-blown academy on seller financing and all the background that goes in that, and negotiation skills, and it's kind of a step-by-step walkthrough of it. I do that. I do personal mentoring as well. So CreativeCashFlow.com, you kind of get the shotgun approach from me here on these Grant Teach Me Somethings. We don't have graphics. We don't have the full-blown academy. But if you want to learn how these creative strategies work, check me out at CreativeCashFlow.com. If I'm giving you away all of this stuff for free, just imagine what's behind the paywall.
Yeah, at the very least, give him a like on his page, people. Come on. And on that, I do want to make one thing clear. We talk about every once in a while. We obviously are not putting Grant or Creative Cash Flow into the guru category. You need to have quality mentors in your life. That's completely separate from the fly-by-night traveling guru situation.
Right.
People that you actually can access and touch and get quality information from and actually want you to succeed, that's who you want in your corner, not people who are like, well, for $9.97 more, I can give you that answer.
I always refer to those people as the pay me $10,000 to learn how to pay me $20,000 for my next program.
That's exactly right. So anyway, this was a long one. I appreciate you watching. I've got no more final thoughts for you, sir.
Nor do I. Thanks for being here. Watch us every week. Next Wednesday, we'll be back, 11 a.m. Grant, teach me something.
All right. Thank you, YouTube. I hope that was good. Facebook, as always, we love you. One of these days, we'll figure out how to do this on LinkedIn, too. What's up?
All right.
Slow-mo high five out.